Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The S&P 500 has seen a big reversal over the past couple of days, an impressive fake out type of move above the 4,200 point level here. If you were on Twitter right here between the 19th of May and the 22nd, you would have seen everybody calling out for the beginning of a massive bull run. You would have seen people calling this a massive breakout on the S&P 500. And we've seen that entire move get retraced very rapidly here. So what does this all mean? Is this the beginning of a much larger move down in the market? Were the arguments that the bulls were making right here at the top actually pretty smart? And we should be buying this dip right here. That's exactly what we're going to talk about in this video. Don't forget to smash the like button if you enjoy this episode, and of course subscribe to the channel if you haven't already. Now without further ado, let's get right into it. The first thing that I want to address in this video is that we did not see this rally coming. If you remember back here in March, we had the banking crisis, we had the SVB collapse that actually ended up being a buy the news event. The collapse of SVB, the banking crisis, and really the expectation of more liquidity being pumped into the system triggered this run on the S&P 500 in a very similar fashion, in fact, to the Bear Stearns collapse here that occurred around mid-March of 2008. You can see it triggered a panic drop initially. You had credit spreads spike as you had that bank collapse, but the Federal Reserve immediately reacted to that event, cut rates. You had a massive increase in liquidity straight away as the Fed was trying to bail out the banking system, and that triggered quite an impressive rally back in 2008. And you can see if we put ourselves back into that situation, look at how bullish this move looks. Apart from this looked like a very powerful, strong, solid move off the low, a big recovery. You can see even a head and shoulder bottoming pattern here as the market was pricing in that recovery that came following the banking crisis, and it took multiple months before the tighter lending conditions that occurred after the beginning of the banking crisis really accelerated the recession back in 2008. And you can see, in fact, if we try and draw a price channel that connects these lows here, these reaction lows, and we draw out the parallel line here to the top of this reaction here in October of 2007, the all-time high, you can see the market reversed right off that level. And so that's exactly the rally that we've seen here between mid-March of 2023 all the way to the 18th of May 2023 following the SVB collapse. That window of opportunity where the market prices in an easier Federal Reserve, the market prices in higher liquidity, lower rates, and starts to see the best of both worlds in this type of environment until eventually the recession gets priced in. So we are in that phase. Now, yes, the S&P 500 rejected off that same price channel resistance. Now, initially we were looking at this version of the channel right here, and that did break out. You can see, of course, if we choose this channel, it's a massive false breakout that just happened. But in my opinion, I think it was a good call to leave a little bit more room on this price channel, because clearly this is the reaction that we were looking for. And in hindsight, especially if we see follow through on this move here, in hindsight, it's going to look obvious that this was the price channel. This was one of the reasons that we had very strong conviction on this latest pattern here, that it was going to resolve to the downside here. It broke out here. Classic stop loss raid above the 4,200 resistance level here, taking out the stop losses of investors who were short on the market right here before really reversing down. The market breadth on this last move was extremely weak. If you were watching our videos throughout the last few weeks here, this was one of the key things we were looking at, the weakening breadth, both in terms of the broader rally here, as we saw higher highs on the S&P 500 between November, February, May here, and also in the very near term here on this last run on the S&P 500, big weakening breadth here. So that's really what the bearish case is on the S&P 500. Now, it could be completely wrong. It could be that we see the S&P 500 reverse and break out here. Why would the S&P break out here? What would be the fuel for that to happen? The idea behind that is to say, well, the unemployment rate is extremely low right now. Consumers are generally pretty strong. We're seeing that inflation is coming down very rapidly, and so we might actually not see a recession till 2024. And if we don't see a recession till 2024, then that means the S&P 500 has a lot of room to run, especially if inflation continues to move down and the Fed begins to react to that and starts to cut rates. And that argument could absolutely be right. And if that's the case, you'll see the S&P 500 move for another few percentage points higher. If we don't see a recession until 2024 and we continue to see earnings climb higher and yet the Fed is pausing monetary policy, you could see the S&P 500 even retest the all-time high before a recession actually does get priced in. That's not what we think is going to happen. You look at leading economic indicators and they're pointing down severely. They're deep in contraction territory. They're saying that a recession is actually imminent. In fact, if you look at data like the durable goods new orders, which is a very accurate representation of economic activity, you can see on a year-over-year basis, this is the year-over-year change in manufacturers' new orders on durable goods, and you can see it's near 0%. You can see what happens during recession. This is in contraction territory. So leading economic indicators, this black line here, is deep in contraction territory, while the S&P 500, this red line, is disregarding it. We made a video a few weeks ago highlighting this divergence, but coincidence economic indicators are beginning to catch up to leading economic indicators and are basically flat year over year and about to head into contraction. So yes, I think, we still are in that phase where the market is pricing in higher levels of liquidity. It's pricing in a Federal Reserve pivot here where they basically keep rates the same. They stop the hiking cycle because inflation is showing signs of coming down, and we really haven't yet priced in a recession. And until this data really starts to materialize, you could have a range-bound type of market. Or if the recession gets pushed out, you could even have a rally. Again, that's not our base case scenario, but we're not worried about that. We're not heavily short on the market right now, and I think, that's something that people often mistake. People don't realize on social media when we are bearish on the market, it is because we are providing an opinion on this channel. But just because we are negative on the market doesn't mean we're 100% short. If you want to know our exact positioning, exactly when we are adding, when we're removing positions, go sign up to gameoftrades.net and you'll see exactly how we're managing the model portfolio through today's macro environment, what type of risk we're taking, and what type of trades we're making. A big part of investing is to know when to make big bets. When you don't know exactly what's going to happen, when you don't have 100% confidence in the bet that you're making, don't participate in that trade or don't take unreasonable risk. This is an extremely uncertain macro environment, and our model portfolio at Game of Trades, the articles that we write all reflect this elevated risk that we have in the market. In the next video, we're going to take a look at how this breakdown follows through, because I think the next couple of days of price action are incredibly important on the S&P 500. There's lots of whipsaws in all sorts of directions here, so stay flexible, stay open-minded. Now, in the meantime, I wish you good luck on your trading and see you next time.